Good morning, everybody, and welcome back to the California Small Farm Conference. My name is Evan Wigg. I'm with Community Alliance of Family Farmers, and we are here on day 3, getting ready to jump into a really important workshop. We're going to be talking about farm access to capital, so planning for success, business planning for access to capital. So great to see you all here, and we're joined by Regina and Allison, who are going to be presenting on this really important topic for any farm business, especially as you start growing and getting your business started. With that, I want to encourage people to use the chat feature. If you have questions for today's panelists, comments, resources you want to share on this topic, feel free to use that. You'll find that chat down below. And also know that we'll be sending out some updated resources after the event in an email. So if you missed something or there's some resources that are shared, we'll try to make sure that gets into an email follow-up, so you have everything after the event. And with that, we hope you enjoy the workshop. And Regina, Allison, you want to take it away?
Sure. Well, thanks very much, Evan. And thank you so much to everyone for joining us today. We're thrilled to be here. My name is Allison Paap, and I'm with my colleague, Regina, and we're from American AgCredit, one of the farm credit offices serving California. So just to give a little background on myself, I've been working with the farm credit system for coming up on 23 years now. And for a little over 20 years, I've been based in Southern California. So I've been working primarily with farmers and ranchers based in San Diego, Orange, Los Angeles, San Bernardino, and Riverside counties. So we work with all different types of farms and all different sizes of operations throughout our lending area. And we're also involved with the local ag community. So right now I'm serving on the board of the San Diego County Farm Bureau and the Riverside Food Systems Alliance. And I am also working with the USDA Federal Advisory Committee to Urban Farms and Innovative Production. So I wanted to give a chance to introduce Regina and let her give a little background on herself too.
Thank you, Allison. So my name is Regina. I'm located out of Sonoma County. Grew up on my family's dairy, now beef cattle ranch. I've been in the finance industry for about 10 years, specifically with American AgCredit for 6 years now, where I lead a team of lenders in our expedited loan program in Northern California, Southern California, and Hawaii. So our expedited loan program is we look at loans with total debt of $1 million or less. We try and make it an easier process for young beginning small farmers to get started. I'm happy to be here.
Great. Well, as Evan mentioned, we want to try and keep this session as interactive as possible. So please feel free to put any questions in the chat or Q&A functions, and we'll be monitoring that throughout our presentation. And we want to make sure that we're answering any questions you have and addressing anything that might be most relevant to you. So I'm going to start by sharing my screen here. Now, can everyone see this okay?
Yep.
All right. Well, so we wanted to just talk a little bit today about some financing considerations for beginning and small farmers and kind of planning for success and supporting the plans and the initial understanding of that financing process to help support access to capital and to help support financing for small and beginning farmers. So what we wanted to talk about today was, talk a little bit about the typical business cycles and the funding sources that people have in those business cycles, and then get into a little bit of the loan application process and talking a little bit about the vocabulary and jargon that's sometimes used in during that loan process are used by lenders and in the banking world that can be helpful as an applicant or as a borrower to really have a keen understanding of some of the vocabulary that's used, and give a little bit of context of where the world of farm credit and American AgCredit fits into the world of lending and ag lending specifically. And then there's time available, wanted to give a little bit of some case study information, highlighting some of the farming trends and things that we're seeing specifically in Southern California. So wanted to start off just before we really get too deep into the conversation of talking about just businesses in general and business cycles, and how we would normally see it divided into kind of different stages to show that early launch stage where it's really kind of a new startup, a new development, and then as the business grows, and it gets into more of that maturity phase, and the type of capital and the type of funding that's typically common or that you would see most likely in those 5 stages. So like the starting off with sort of that launch phase or the startup phase, we normally would see more investment put into it, so higher costs and maybe a little bit lower revenue. And in that growth phase up into the shakeout phase, we start seeing the revenues climb, and then into the maturity and decline phase. And so within those different times and the different parts of those businesses, there's a lot of different types of capital available. And what we would be looking at then is it's really kind of based on this risk analysis. So we would, in that early phase, the launch phase, that's typically the highest risk phase. And so the most common types of capital or the type of investment we see is from private investors. And so typically people would bring in a partner, or they, look at other sources to get, access to private funds. And as the business grows and matures a little more, then there's typically more avenues to getting to different access, where you may look at more traditional bank financing, or looking at, things that might be available to support as the risk of that business being able to earn enough to pay for its own operations, plus commit to a repayment schedule and to be able to make those debt payments. So I want to just to give a little bit more of an example here. So what I'm talking about, especially when I'm talking about that partner or the private investor area, that's typically just bringing in a business partner, and people bringing their own capital through their own savings or their own sources of cash to the table. Oftentimes we'll see like an angel investor or silent partner kind of in this phase, or even crowdfunding. The donation-based platforms, equity-based platforms, or some of the reward-based platforms are what is oftentimes utilized in that early phase, where a business may show some signs of growth and may show some signs of development and viability, but not quite ready to commit to a repayment schedule where that business would be able to pay, debt back every month or every quarter. And then some of the specialized lenders that would kind of step in maybe in one step after that would be looking at, the farm service agency or a different farm credit association. There's a community development finance institution. So for example, there's an example of a CDFI in San Diego called Accion, which is really geared toward that kind of middle step, where the business has some history and there's some of that initial investment from the business owner, but it's maybe not, it's still kind of growing and hasn't quite reached more the next levels of its potential. So, so that when we're talking about specialized lending and we're talking about, different access of types of lenders, that's really what we're talking about, is having that consideration of where is the best place for me to look for support for the business? What stage am I in? And what am I using the money for? And so this is really kind of a slide I wanted to talk about. If you're at a point where you're ready to take on some debt to expand the business, to make a larger purchase, we see this specifically around like when a business may be looking to expand and buy some additional equipment or invest in other technology. Things about how will what I'm buying will this purchase help my business generate additional sales or additional income? How is this going to enhance my overall operation? Do I need this item? Why am I going to do it? How is this going to help build the business overall? And then really kind of look at, if I take on this obligation, is this going to compromise my ability to be able to continue to operate? Or is it going to compromise my ability to be able to grow or to buy something else that may be a goal for me to purchase? So after you've kind of made those considerations and made some decisions, yes, I do want to purchase something, I do want to make an expansion, I think I'm ready to apply for a more conventional loan. What are the next steps I need to take? So really kind of rolling into the next section, what we would advise is really looking at the financial information that you have available and really considering your business plan and your farm plan. So understanding what information I would need to show a potential lender in terms of financial information and business plan information. How is my credit score going to impact this whole process, and how will this loan impact my credit score? And am I sure I'm asking for the right loan product? So when I say loan product, what I really wanted to talk about was, in the world of lending, loans are typically classified into kind of two main categories. There's the consumer category and the commercial category. So the consumer category are loans that's debt that you take out to support your daily living expenses. So it'd be things like your car loan, your personal residence, your home loan. If you have credit cards, that kind of thing, those fall into the consumer debt, and the borrower is generally a person. And so it's that person borrowing money to support their daily living. A commercial loan is a loan that is to support a business or an investment. So things that, that would be like if you're buying rental property, if you're buying farm property, farm equipment, or, if you're looking at taking out a short-term operating note to support the farm operations, those are all in that commercial category. And in that category, the borrower can be a person, but oftentimes it is also a business entity. So like a little limited liability company, a corporation, or a partnership, or common entities that we would see in the commercial category. And I wanted to bring this up too, because commercial loans and consumer loans are two totally separate loan products, and the terms and conditions for those loans don't typically overlap. So if you're following some of the information that you might hear on the news or see online about the home loan market, and they're giving quotes of 30-year fixed rates, that's a different loan product than what you would find for a farm loan. And a farm loan is really more comparable to a true small business loan. And in general, what you would see is a term would generally be a little shorter. So instead of having a 30-year loan, it's more common to have like a 15 or 20-year loan. And rates are generally a little bit higher on commercial loans than they are in consumer loans in general. And oftentimes, the ability to fix rates long-term may not be quite as universal. Whereas, for most home loans, you can get a 30-year fixed rate from pretty much any lender. And in that commercial category, to do a long-term fixed rate is sometimes a little bit more restrictive or not always truly available. So kind of going into that next phase of you recognize that, you're looking at trying to finance something for your farm, and you want to look at moving forward with that commercial category. You want to start getting together some of the general information that you would need to provide to a lender about what the farm's financial situation looks like, what your personal financial situation looks like, and what the overall vision for the business is. So we'll let Regina kind of kick it off from here and talk a little bit more about that.
Perfect. And before we do jump into that, it looks like we do have a few questions already. So Alan is asking about emergency types of loans for emergency funding for stream bank repairs, especially following the recent storms. So we do have different, depending on what you're looking to do exactly, different loans, but then we'll go into a little bit. We do partner with USDA. We're separate from USDA, but we do partner with them on certain programs for or crop insurance, things that are going on in different commodities. And so we will touch on that a little bit here, unless Allison, you had anything to add on onto that. But the next.
Yeah, no, just to reiterate that typically when you talk about emergency loans, that those are programs that are administered by the USDA through the Farm Service Agency, and the Farm Service Agency would have specific characteristics on what qualifies as an emergency situation. And then they have, a very specific program that's laid out as far as how much money would be available to lend out to borrowers and what the repayment terms would look like. But that would be all done with the Farm Service Agency specifically.
And it's like next question, Mary wanted to just kind of clarify, are specialized lenders focus on the launch stage or the growth stage? Allison, if you wanted to touch on that slide again, maybe quickly.
Sure. Well, so it really kind of depends on the lender, and then that launch stage. There are some lenders that will look at doing something that's a little bit more of a startup, but because that does represent the highest risk, what a more traditional lender or even a specialized lender would be looking for is some additional outside support. So oftentimes you would be looking at either pledging additional collateral or, providing, additional guarantees, that kind of thing. And so, really for most lenders that are going to be looking at that traditional structure where the money goes out and it gets repaid through a periodic process, they'd want to see at least a couple of years of experience. I don't know. Do you want any other to add, Regina?
No, that sounds perfect. And then last question here, how would commercial loans apply for a nonprofit farm?
So
go ahead, Allison.
yeah, I was going to say, so nonprofits are a kind of a niche within a niche within a niche, because oftentimes that the repayment on that is really dependent on specific donations or specific contributions. And so there's some lenders that are really set up to specialize with that, and they have kind of specific parameters set up for what would be required as far as having, reserves and that kind of thing available to help mitigate some of the risk. But in general, whether or not the corporation or the business entity is officially a for-profit entity or a nonprofit entity, it doesn't impact, that really just impacts primarily the tax treatment of the entity, and it wouldn't impact that type of loan product, because that really, the consumer loan product is going to be designed for an individual and for their daily living expenses. And no matter whatever how the entity is organized in the tax treatment of that entity, you would still be in that commercial category. And again, the commercial category in general is going to be geared toward having a little bit more conservative terms.
Perfect. All right. Well, then we're ready to kind of start to dive into the meat and potatoes here of that loan process. Allison, if you want to go to the next slide. Perfect. So the 5 C's of credit. This is a huge thing. Lenders are well known for. We all pretty much assess the 5 C's of credit, maybe in different capacities, but it all kind of goes off of these basics. So the 5 C's are character. That's essentially the lender's opinion of trustworthiness, experience, reputation, capacity. That's really looking at a borrower's ability to repay the loan based on income, based on current debt, new debt, capital, that's going to be a borrower's personal investment in the ag operation, kind of what skin you have in the game there. Collateral, that's going to be what the loan would be secured by. So typically we're looking at land, livestock, equipment. And again, typically what we are looking to fund is what we would secure that with. So if you're looking at purchasing real estate, we are going to most likely secure it with that real estate. And then lastly is condition. That's the use of the funds and how it will be monitored. So the next few slides we'll kind of dive into a little bit deeper on all of these and kind of see how those apply. All right, so diving into the first C of character. Character does sound very subjective. However, one way we can measure character is through a credit score. So a credit score really shows a lender your credit history and ability to repay. Credit scores are created from multiple factors, as you can see here, with payment history being the largest. A bank is taking a risk lending money to you. So that payment history allows us to see how you've handled payments in the past and how you handle them currently. And then as you can see with debt level being the second largest, it's important when taking on debt that you're not over leveraging yourself and you do have that ability to repay your debts. And then time with the credit bureau is kind of the other one here, kind of helps with those different risk factors. The longer you have credit and good history, again, the kind of less risky you are. So now we know how important credit scores are. So how can we get and maintain a good credit score? Some pretty basic things here: avoid high credit balances on open accounts, make your payments on time. Big one is avoid tax liens, collections, bankruptcies. Those unfortunately stick out on your credit score for quite a while and can be a hard one to get rid of. So negative impacts here, again, pretty obvious ones: avoid late payments, avoid having a portion of your balances owing being too high. So if you have, a credit card or a line of credit for $50,000, if you're only utilizing, 10% of it, that shows you're a little bit riskier than you always have that balance there fully drawn. Lack of credit history, opening too many accounts in too short of a time, foreclosure, bankruptcy, collections, again, too many inquiries at once. And like I mentioned, some of these take a while to drop off, such as bankruptcy. So that's where, especially that length of time comes into play a lot to kind of help out balance if you have had any negative impacts. Another way we can judge character is knowing that you know your business, having a business plan, having organized financials. So business plan, farm plans, those could be based off of historical results. Those could be off of projections. We know the ag industry is very up and down. So maybe the previous year is not an accurate representation. Maybe you're changing your business model. So it's totally okay to have projections as well and change that. And then just having quality financial information. This is a big one. You don't have to be a CPA yourself or a financial expert, but getting the help you need, being organized, really knowing your balance sheet, your tax returns, and kind of putting together some budgets and farming plans will really set you apart in knowing your business. So again, as lenders, we are taking a risk lending money and are essentially going into a business agreement with you. So we want to make sure you, as our business partners, know and are confident in your business, especially a startup business. We want to know you've done your research and really thought out your business plan. So really important thing to think about, even if you're not applying for a loan, it's important to have it. It doesn't have to be long, lengthy, but a basic roadmap that applies to your business and your farm. And these are just a few components here. A mission statement. Again, it doesn't have to be anything fancy, but what does success look like to you and your business? What's your farm strategy? Marketing, management. Again, looking at financials and making projections. We can't always predict where the ag industry and your commodity is going to be, but having a good understanding of that is definitely things that will help you when times, don't go as planned. You at least have have thought about it. And we'll send the slide deck out to you guys, but here are a couple of resources just for some helpful online resources to get ideas if you're looking to build a business plan. And again, we'll send these out for you. You can look at them in your meantime, but these are through USDA, SBA, all great programs, separate from American AgCredit, but definitely great resources. Okay, so when describing your story to a lender, it's also important to understand the vocabulary, making sure we're all speaking the same language. So here are a few common banking terms that you might hear from a lender. And then we'll kind of go into detail on each one here on the next couple slides. Okay, so balance sheet. This also ties back to, going back to our 5 C's of credit, this would tie back to the capital section. And this is basically what you have invested. Kind of like Allison mentioned at the beginning, we do want to see that you have a little bit of skin in the game. We're obviously, as lenders, here to help you make those investments, but it is important for us to look at your balance sheet, which is really a snapshot of your business and personal financials at that specific point in time. So basically, anything owned and anything owed. So with balance sheets, there's 3 major components. On the left-hand side, you're going to look at assets. Again, that's basically what your business or you as an individual own that has value. And then on the right-hand side, we have the liabilities. So any claims, any loans against the business and that individual. And then again, another great thing for you to know for yourself and your business is net worth or your owner's equity. And that's basically just taking that dollar difference between your total assets and your total liabilities to find out what your equity is. All right, so kind of diving deeper into that balance sheet, again, as I mentioned, on the left-hand side, you have your assets, which are made up of current and non-current assets. So current assets are basically any owned items or amounts owed to the business that are cash, or that could be converted to cash easily within your operating cycle. So typically we'll look at that as a 12-month operating cycle. So cash savings accounts, that's obviously an easy one to liquidate. Marketable securities, accounts receivables, profit inventory. And then you also have your non-current assets or long-term assets, and that's basically everything longer than one operating cycle. So machinery, equipment, breeding livestock that you're keeping, retirement accounts, vehicles, real estate, and different types of real estate, rental properties, residences, and agricultural properties. And then on the right-hand side of the balance sheet, we have our corresponding liabilities. So again, broken up into short-term, long-term. So current liabilities, again, any obligations due within the next 12 months. So typically accounts payable, operating loans, and then current portion on those long-term loans. And then long-term liabilities, again, kind of looking at everything over a year. So it's typically home loans, real estate loans, car loans, and equipment loans. All right, perfect. So what do we do with the balance sheet once we have it? We do have different ratios. Each bank will kind of look at it a little bit differently. And again, just a reminder, these are all just good resources for yourself to know where your business is at, even if you're not applying for a loan. So some liquidity measures that we can use and that you can utilize off your balance sheet is working capital, which basically represents your operating liquidity. So your cash available to the business. So you would take your current assets minus your current liabilities. That's a quick, easy ratio to, again, see what liquidity you have quickly available. As well as current ratio, which is your current assets divided by your current liabilities. Again, just helps show you what adequate coverage you have for those current needs. And then again, here's some more ratios. Again, we'll send this slide deck out to you so you can take a look at these, kind of test out your own little ratios for yourself. But again, here we're really just looking at your overall financial strength, your net worth, which again, we kind of went over a little bit, but that's taking your assets minus your liabilities to get your true net worth. Similar ratios, we have owner's equity and debt to equity ratio, which again, you just want to see what your overall strength is, and it's important for you to know that for your business as well.
Just real quick before we move off the slide, one of the reasons I think we wanted to just bring this up and talk about it was really the analysis that because it gives a little bit of a snapshot of the analysis that most lenders, whether it's a specialized lender or a more traditional, bank lender, that kind of thing, what they're going to be looking at in terms of the overall financial condition of the business, the overall personal financial condition of the applicant, trying to figure out, is there enough cash available to continue running this business? And is there, if there is a hiccup in the plan, is there access to cash, or is there access to something that could get sold to help make sure that the business can stay viable, that can stay operating and continue to make debt payments? So.
And I think we do have a question here I can answer really quickly before we move on. Question is, can you go over basic criteria of who you can or cannot lend to, credit score minimum, citizenship, etc. So each bank will be a little bit different. At American AgCredit, we don't necessarily have a credit score minimum. Basic, kind of, again, all banks, including ourselves, are going to go off of many things, but definitely work on getting your credit score up. Once we get below typically like a 650, it's a little bit harder to get approvals. Again, many factors that factor into that. And then at American AgCredit, we do need to have a U.S. citizenship as well for applying. So kind of going now more into the income statement side, this kind of goes back to 5 C's of credit. This is looking at the capacity section. So really looking more at your income. Here's a few basic terms here, just kind of knowing what these different terms are. So the big one is really your income and your cost of goods. Those are really looking at your true input costs and your margin, which would be taking your income minus your cost of goods. And then we do, of course, have other expenses. As we all know, we have accounting fees, labor, taxes, utilities. Those are typically referred to as your overhead expenses. And then those help you get your net income. So it's taking that income minus those expenses and taxes for an accounting period. And then your repayment margin, those are your funds available to cover any obligations. Again, we want to count those as well for additional buffer for living expenses and to build those capital. So these are all good numbers to help plan out so you're not over leveraging yourself and you have the ability to repay your loans and count for any surprises that might come. So a couple of budgeting basics, income, historical or projected yields. It's really important to look at, and it's also important to look at that with productive units. So taking acres or per head to estimate, your most likely income scenario and those expenses that are associated with it. So while it is nice to be conservative, it's not always advised to use a worst case or best case, but to truly understand how both of those impact your income expenses and understanding your commodity. Working capital plays a part into your risk tolerance with kind of understanding your worst case scenario and making sure you have that buffer. And you know, you're not going to hit a home run every year. Ag industry has its ups and downs. And understanding what's the timing of your sales, when will you receive your actual income? These are all important things to know for yourself, as well as if you're going to apply for a loan. American AgCredit, we do work closely with you. If you know when you get your income for the year, we want to correspond your loan payments to match. We don't want to set you up with an annual payment, you know, in beginning of harvest season when those are all your expenses coming through. So truly knowing your specific operation is important with these budgeting basics.
Yeah, and I think just to reiterate that sometimes it's helpful really to look at it in terms of the production unit. So like, for example, if you are a small winery for, you know, and you're looking at your product that you're selling are, you know, cased wine or individual bottles of wine, if your projection requires that you have to sell every bottle at $200 a bottle to make your to really make the business work as planned, that's kind of the question of like, is that reasonable? Can I really command that kind of sale price, that kind of thing? And those are the questions that a lender is going to be asking too, that if you present a budget and the budget shows that, you know, you're going to on average get $200 a bottle for your wine, the lender is probably going to say, tell me more about that. Tell me how you really, how that's going to work, because that is like a super premium category.
I do notice we are coming up on time, so maybe we'll send this slide out, kind of just goes over some basics when considering some debt considerations here. We go to the next one. And yep, there we go. So this is an important one, I would say, is truly, again, not only understanding your operation, but if you do get into a loan, making sure that you are understanding what the terms of the loans are, the use of the funds. This kind of ties back to that final C of credit with conditions. So do I understand the interest rates and the fees? If not, ask the questions. Are there any concerns with the repayment? Again, as a lender, we're going to assess this, but you also need to be accountable for what you know that you can repay and be comfortable with knowing your operation. So are there any reporting requirements? Again, sometimes we'll put in things into place to make sure that we are catching things before they go bad. Again, and it's important for yourself as well to watch those. It's always a lot better to let your lender know, or for you as yourself to find if income is not going as planned or expenses are higher. So it's better to catch those beforehand than when it's too late. So that's why sometimes you might see some different annual reporting requirements on a loan. So how does Farm Credit, American AgCredit tie into all of this? So Farm Credit is a nationwide network of lending institutions that provide financial services to agriculture. We are customer-owned, so cooperative nationwide. We were created by Congress in 1916. Not government funded, but we are federally regulated by the Farm Credit Administration, and there are over 60 farm credits, I believe, association nationwide. Farm Credit is the largest lender to agriculture, serving approximately 40% of the U.S. ag sector. And we have a 100-plus-year-old mission to support rural communities in agriculture with reliable, consistent credit and financial services today and in the future. So here's a few numbers. Again, we'll send this out. This is as of 2021, so they're pretty conservative to where we're at now. So within the Farm Credit System, American AgCredit is a proud member of that Farm Credit System. So this map kind of shows a quick snapshot of the different territories we cover. On the right, there's a few territory facts. Again, these are as of 2021, so a little bit more conservative to where we are at now, but some nice numbers to see. So we are set up to fund agriculture. That is all agriculture. So we definitely have some commodity diversity here. which really helps withstand market pressure on any particular commodity and help stick with our customers through tough times and ensure we are positioned to pay out a patronage. So as you can see here, if vineyards are having a rough year, the timber industry is booming, and that really helps create stability for our company to be able to pay out our patronage, which American AgCredit. So since we are a co-op, when you are a borrower with us, you are essentially a owner as well. You purchase a stock account, and that enrolls you in our patronage program that we've been able to return 1% back to our borrowers and share those profits with our borrowers, since you're essentially our owners as well. So this commodity diversity really helps secure that for our owners. And then, as mentioned earlier, we're set up for agriculture. We do have loans, but we do have other partner organizations we work with that we want to help get you to the best partner. So these are just a few snapshots of some of the people that we work with. AgDirect, they specialize specifically in equipment. They have some really great competitive rates. AgWest, they are our country home loan program. They are still under the farm credit system. They just have a little bit more ability to lend on rural residential loans that we at American AgCredit sometimes cannot lend on. And then, as mentioned before, we partner closely with USDA, separate entity from us, but we do partner really closely with Farm Service Agency. And then, as well as we have some crop insurance programs, as well as we actually have some life insurance programs as well.
So I know we're pretty tight on time, and there's just a couple of questions I wanted to address and that came in through the chat and the Q&A. So one of the questions that came in was about specifically what are the types of ratios that lenders look at, like what's the exact number and that's a little bit of a tough question to answer because every lender is going to have a slightly different underwriting standard. But in general, they're going to be utilizing those a measurement of a liquidity ratio and a measurement of a leverage ratio to really get that idea of how much cash is available to support the operation, and then how much would be available if something had to get liquidated or if there was going to have to be a quick change in the business to provide that buffer. So in general, most lenders are going to be on that liquidity side, are going to be looking for something that's more than like that 1-to-1 ratio number. So what Regina went through, the idea of like the amount of cash that you have compared to how much cash is going to have to go out within the next 12 months to vendors or other with other receivables, how much is due on your operating loan, that kind of thing. A pretty common ratio you're going to be looking at is somewhere in that 1 to 5 to 1. But again, I can't quote an exact ratio because every lender is going to have a separate underwriting standard. And then on the leverage side, it's kind of back to that, looking to show that there's enough equity in the overall balance sheet to support the debt. So I can't, it's going to depend on the lender, but really kind of that something to show that there's more equity than debt, is a pretty common, kind of standard that we'd be looking at. And then another question that came in through the Q&A is about kind of expanding among the diversity of the borrowers beyond just commodity diversity, and looking at things around gender and racial and other demographic statistics. And we are an equal opportunity lender, and our limitation for lending is really based around specific geographies, in the sense that we have particular lending territories that we're limited to. So kind of going back to that map that we showed up, where most of California, Nevada, Colorado, parts of Kansas, and Hawaii. And we can lend to anybody involved in agriculture in those areas. And but we don't necessarily track that demographic data because we are an equal opportunity lender, and we are looking at wanting to lend to anyone that's working in that production ag function or a farm related business function within our lending territories. In general, I would say though, depending on that area, we would, depending on the overall demographics of the area, it would mirror kind of our borrowers. That, for example, San Diego County has more small farms than most other counties. So we, the borrowers that we would see are looking at in our portfolio from San Diego County, you'd see more small farmers. Same, women farmers make up a little bit higher demographic in San Diego County than in other parts of the country. So we would see, we would generally see more women borrowers based in those areas too. And let's see, another one came in. And then, yeah, that just talking a little bit about the landscape of the ag agencies and the different things. So thank you to everyone that submitted questions. I think really just sort of to reiterate what we're looking at as far as trying to support that overall business is to make sure that you really understand the financial place of your business, that you can really communicate the story of your business through the numbers, and that you have that information that you can communicate with a lender in the language that the lender is going to expect to hear from. So things around assets, liabilities, liquidity, leverage, that kind of thing. And I think we are officially over by a few minutes. So thank you again to everyone. And as Regina mentioned, we will definitely be sending out the slide deck that, so you can utilize some of the business planning resources and look a little bit more closely at some of those definitions to help you start getting your own information together and calculating your own ratios.
All right, terrific. Well, thank you so much for coming and presenting. Really appreciate all of the valuable resources you're sharing. Hope everybody enjoyed today's workshop. We've got lots more this afternoon and tomorrow, so hope to see you at the rest of the conference, and look for more information from Allison and Regina. All right, we'll talk to you guys soon.
Thank you.